Let's jump right into it. Today, we're unpacking a financial event of truly unprecedented scale. Elon Musk is gearing up for what's poised to be the largest initial public offering in human history, aiming for a staggering valuation for SpaceX. But beneath all the sleek rocket animations and the Wall Street hype, there's a complex financial reality that traditional media is just completely glossing over. So we're going to bypass the noise and dive straight into the actual numbers, the corporate structure, and the hidden market mechanics driving the headlines. Okay, let's dive into this. We're looking at the absolute central paradox of this entire historic offering. On a consolidated basis, SpaceX lost nearly $5 billion last year. Yeah, $5 billion. Yet it's marching toward an astronomical $1.75 trillion valuation. So the obvious question you should be asking yourself when you look at these numbers is, who on earth is the buyer at that price?
Well, the shocking answer is you. Whether you actively trade or not, within just a few weeks of this listing, your passive retirement accounts, your index funds, your 401k, they're going to be some of the biggest buyers of SpaceX stock. And honestly, the most shocking part of it all, you won't even have a choice in the matter.
To really understand why this is happening, we first have to wrap our heads around the sheer gravity of this number, $1.75 trillion. This isn't just a big number. It fundamentally rewrites the scale of public markets. I mean, the only way a valuation of this magnitude makes any mathematical sense is if the company actually aligns with what the public assumes it to be.
To put that into perspective, at this target valuation, SpaceX would be worth more than every single American defense contractor combined. It'd be worth more than the top 10 companies on the London Stock Exchange combined. It literally surpasses the combined market caps of legendary American consumer giants, Coca-Cola, McDonald's, Disney, Nike, and Starbucks, all of them put together. But here's the thing, SpaceX isn't just a rocket company. It's actually three completely distinct businesses stacked on top of each other. You've got the good, the bad, and the very ugly. We need to deconstruct this stack, starting with the most problematic piece of the puzzle, xAI. Now, what's really interesting here is the massive discrepancy. A few months ago, SpaceX acquired Elon Musk's AI lab, xAI, in an all-stock deal that valued xAI itself at $250 billion. Let's compare that to the rest of the market. OpenAI generates around $24 billion in revenue for an $850 billion valuation. Anthropic pulls in over $30 billion for a $400 billion valuation. But xAI, it estimates a mere $1 billion in revenue, but was bought for $250 billion. The market is pricing it like a premium luxury airline, but the actual financials look a lot more like a budget carrier. And the internal reality of xAI is even more severe than that valuation gap. The company was burning through more than $1 billion a month. Despite starting with a heavyweight team of 11 researchers from places like DeepMind, Google, and OpenAI, by March of this year, every single one of those 11 co-founders had walked out. The CEO of SpaceX essentially paid $250 billion for an asset that, by his own public admission, needs to be rebuilt completely from scratch. In financial terms, you can kind of think of xAI as the reverse Jerome Powell. Instead of printing cash to stimulate the system, it acts as a massive incinerator. It actively burns whatever cash the rest of the SpaceX businesses manage to generate. And remember, xAI is just one of three divisions here. Take the famous rocket business, for instance. You know, the part of the company that actually launches satellites, runs ISS cargo, and handles NASA missions. It generated a totally respectable $4 billion in revenue last year. But the true financial engine of SpaceX, that's Starlink, bringing in $11.4 billion. The rocket business, the actual namesake of the company, only represents about a quarter of total revenue. This staggering efficiency is why investors actually care. Just 2 years ago, Starlink's profit margins were sitting around 41%. Today, they've accelerated to 63%. Adding over 20 points of margin expansion in just 2 years is absolutely phenomenal. This satellite internet provider is, without a doubt, the undeniable crown jewel of the portfolio. And Starlink's dominance is scaling faster than literally any telecom company in human history. We're talking about an infrastructure of over 10,000 satellites, beaming internet to over 10 million active subscribers across roughly 150 countries. It's expanding rapidly into highly lucrative maritime and aviation sectors, and it's locking down classified defense contracts through Starshield with the Pentagon.
So here is the crucial reality check. Last year, the rocket business and Starlink combined brought in roughly $8 billion in profits. That is a brilliant business model. But when you consolidate the company and factor in the massive cash burn from XAI, that profit is entirely wiped out. The consolidated SpaceX entity ends up posting a nearly $5 billion loss on $18.5 billion in revenue. Which brings us right back to our original question. Who exactly is buying this at $1.75 trillion?
To find the answer, we have to look away from the rockets and look directly at the hidden machinery of the stock market. Because right before the biggest IPO in market history, the financial system quietly changed the rules. On May 1st, NASDAQ adopted something called the fast entry rule. And this brilliantly illustrates what's going on behind the scenes. The NASDAQ 100 is the gold standard for growth companies, tracked by over $600 billion in passive index funds. Under the old rules, a company had to wait 3 months to be added. This allowed for natural price discovery, right? And they needed a minimum 10% free float of shares available to the public. But under the new fast entry rules, that 3-month wait is dangerously compressed to just 15 trading days. And that minimum free float requirement, it is completely gone. But wait, it gets deeper. Buried in the technical language of these new rules is a hidden multiplier. For companies with a free float under 20%, NASDAQ now legally treats that float as if it were 3 times bigger than it actually is. So here's what this manufactured demand looks like in practice. SpaceX is reportedly targeting a tiny 4 to 5% free float. 6 months ago, that would have automatically disqualified them from the index. Today, not only do they qualify, but they skip the standard 3-month seasoning period entirely. And because of that 3x multiplier, ETFs and passive funds are legally forced to buy SpaceX stock at heavily multiplied weights almost immediately after it goes public. They have essentially engineered a red carpet of automatic demand. Now, let's look at who actually gets to participate in this heavily engineered event. In a standard IPO, roughly 5 to 10% of the offering is allocated to retail investors, everyday people. But SpaceX is reportedly targeting a massive 30% retail allocation. SpaceX CFO Brett Johnson recently spoke to a room full of bankers about this, stating, "Retail buyers have been incredibly supportive of us, and we want to make sure that we recognize that." Now, on the surface, that sounds like a fantastic reward for loyal fans of the company, right? Let's translate that out of corporate speak, though. This isn't about rewarding loyalty, not at all. It is a strategic maneuver to dump 30% of the supply of an IPO at its absolute peak valuation directly onto retail buyers. Portfolio manager George Noble actually summed up the mechanics of this situation with a stark, undeniable truth. Your 401k is the exit liquidity. This is what we call the passive trap. I mean, we've all been sold on the brilliance of passive investing, right? Set it and forget it, low fees, broad diversification. But the dark side of that convenience is right here. Insiders sit on their low-cost shares. The shares unlock at a peak $1.75 trillion valuation, and the very same mechanism that makes passive investing so easy legally forces your retirement account to buy this overvalued, unprofitable stock automatically. You have no vote, you have no say in the matter, which leaves us with this final thought to consider. The rules of the market have been quietly rewritten to ensure that the largest public offering in history has a guaranteed automatic buyer. So, as you look at your own retirement dashboards this month, ask yourself, are you prepared to be the automatic exit liquidity for a $1.75 trillion valuation? Keep analyzing the data, stay focused on the mechanics beneath the headlines, and thanks for joining me on this explainer.